Good afternoon, everybody. Today's webinar is on closing of the books. My name is Roman Basie. I'm president of Basie and Associates at the Center for Financial, Legal, and Tax Planning. And as most of you know, I'm an attorney, CPA. I also hold a master's in business administration. I'm a real estate broker and a title insurance agent as well. This has been a topic that has become of great concern to many businesses across the country. If you are a S corporation, and we're going to talk about that in today's lecture, but if you are an S corporation or you're an owner in an S corporation or you're a partner in this type of a flow-through entity, pay particular attention to today's webinar. And don't tell me just because, say, Roman, I'm an LLC, so I don't have to pay attention. No, because if you are an LLC, you may be taxed as an S corporation, and therefore today's lecture impacts you. So let's take a look quickly at the first slide, and it says corporate structure. So of course, many companies in the US today are corporations. S corporations are becoming even more commonplace in the business world after the Tax Cuts and Jobs Act, now due to the 20% deduction. And let's just review this briefly. Do not get this confused. If you have an S corporation and if you're the owner of an S corporation, your tax rate is not 20%. Your tax rate, if you're a particular type of business, you will get a 20% deduction of your profits and then pay tax on the rest of your profits at your ordinary income tax rates as high as 37%. We have begun to do analyses for companies across the country to determine whether they should remain as S corporations and pay tax at the 37% level or whether they should convert to C corporations. And let me give you this little nugget of information. In a nutshell, if you're keeping earnings in the company every year and you're using those earnings later on for investments or future expenses or whatever they may be, you may be potentially costing yourself taxes by remaining as an S corporation in 2018 and beyond. If you are not keeping the profits in the company, in other words, your company has 100,000 of profits at the end of the year, and you're taking a bonus or a salary of $100,000 at the end of the year, wiping that profit out, okay, then maybe you will not benefit from the conversion. But we are starting to analyze companies across the US and making that determination. Third bullet point, S corps typically have few shareholders. They are not publicly traded, and they must have less than 100 shareholders is what that should say, not employees. If S corporations have few shareholders, what happens if one or more are bought out or if they have their interest terminated? And that's what today's webinar is about. In other words, if you're in business and you're going to sell your company and you are an S corporation and you are going to sell your company during the tax year, not at the beginning and not at the end, you have an implication that you need to pay attention to. Here's what it is. The regular method. Typically, an S corporation has their tax date end during the same period as a C corporation. So even if a shareholder has their interest terminated or bought out, the remainder of the shareholders can choose to finish the tax year as planned. By choosing this method, the shareholder still receives profits and losses following their stake in the company at the year's end. What does this mean? If you sold your business on March 31st, or you sold a portion of your stock on March 31st to another shareholder or to a third party, and let's say you were a 50% owner, you will still be taxed on 12.5% of the yearly profit at the end of the year. The profit is calculated at the calendar year end. It is not calculated on March 31st. This is the regular method. So if the company earned $100 during the year, you're going to receive a K-1 that says you're being taxed on $12.50. Whether or not the company made that profit while you were an owner or not. That is the regular method. Now let's take a look at the closing of the books method. This is the second method. It may prove better for the company, for the shareholder that sold out, for the shareholder that didn't sell out. Instead of closing the books during the normal tax period at the end of the year, the shareholders may hold a special election. With a unanimous vote of the special election, the remaining shareholders can elect to end the tax year when the departed shareholder leaves. And then they start a second tax year that ends on the usual time, the end of the year, end of the calendar year. So for example, again, if you're a 50% owner and you had your interest terminated on March 31st and the remainder of the shareholders elected to close the books, then your equity and profit ends right there. You do not take part in the following 3 quarters. So whatever the profit is at that point in time, if you're a 50% shareholder, you will report 50% of the profits as of March 31st. Anything that happens after that has no impact on you. Now, most of you are going to say, well, Roman, that seems like the more fair method. Well, you have to have a special election. You have to have this determination in order to be able to do that. And let's take a look at the reasonable method. The reasonable method is the final method available. It allows a partnership, so to speak, or an S corporation to allocate taxes pro rata for departing partners while allowing the partnership to collect some profit for the rest of the year. This method is largely based on contributions to the partnership for the departing partner. Take a look at our example. I know it's a lot of language in those bullet points. Let's look at our example. A partner that departs from a law firm contributed to a case that's going to be settled 6 months later. The firm can opt to pay them for that profit and still have the new partnership structure remain the same. That's going to be allowable under the reasonable method that's allowed with the IRS. You may have a lot of questions about your current business structure, the financial, the tax preparations. Feel free to contact us. There is our information. There's our phone number, 618-997-3436. Also, our email is available at info@taxplanning.com and our address of our corporate office here in Illinois. Once again, if you're in business and you are potentially selling your shares in your company, then you have this 3-pronged option that you've got to decide on. Are you going to decide on the regular method, the closing of the books method, or is there another reasonable method that you want to employ with your partners? Thanks again for joining us for today's webinar, and we'll be happy to talk with all of you next month as well. Speaking engagements coming up. So on April the 26th, we are speaking at the American Supply Association Women's Spring Conference on personal finance. On April the 27th, we are speaking in Tampa for the Internal Revenue Service's annual filing season program for tax return preparers across the United States. And next week, you can find us at the International Business Brokers Association. My father, Dr. Bart Basie, is giving 3 lectures at IBBA this year. So please plan on attending that. And I will be in attendance during the exhibitors conference on Friday, May the 3rd. Look forward to seeing all of you. Thank you.